we've got a everything boom right now, everything bubble, where everything seems to be going up, certainly in America, because there's been so much liquidity being created. If you start to go higher on the page and you go above the dotted line, we're going to get the reverse of that, which is called the everything bust. Enjoy the party, but dance near the door.
Today's episode is brought to you by the Tucrium Wheat Fund. War, weather, inflation, and even monetary policy drive wheat prices. Explore the opportunity at tucrium.com. By the way, Michael Howell's market views on assets such as stocks, gold, Bitcoin, and much more starts at the hour 15-minute mark. So if you're interested only in that, you can skip to the 75-minute mark. I wouldn't recommend it, but just so you know. All right, let's get into it. I'm very happy to be joined by Michael Howell of Crossborder Capital. Michael, great to see you. Welcome to Monetary Matters.
Well, great to be here, Jack. Very excited. Lots to talk about. 2025 is going to be, I think, a challenging year. So let's get going.
I'm really glad you're here, Michael, because you have been talking about a bull market over the past 2 years, and that is exactly what we have had. Many people were bearish. You were one of the very few bulls in early 2023, late 2022. So this entire way, we weigh up in risk assets. I think your view of liquidities have been very, very informative to what's actually been going on. I guess I want to ask you now, Michael, what is your view on global liquidity right now? And what's your view on risk assets such as stocks for 2025?
I think basically liquidity is going to increase next year, that's for sure, in terms of the supply of liquidity. I'm still pretty optimistic. I think the fact is we've got to recognize is that the momentum of liquidity is beginning to slow down probably quite noticeably. And that's really coming, I would suggest, from two directions. One is that if you look at the impetus that the US is delivering, that's beginning to slow down. Now, what I'm really saying there is I'm not talking about interest rate cuts. I mean, I don't think interest rate cuts really matter a jot, to be perfectly honest. But what we've got to look at is the amount of liquidity that's entering the system, both explicitly from the Federal Reserve and implicitly from the US Treasury. And there are things that we talk about, which we can go into a little bit later, which are things that we've described as not QE and not yield curve control. And those have been, if you like, hidden stimulus, but they've been very noticeable and probably, add up to several $1 trillion of liquidity. They're beginning to slow down. I think one of the questions we've got to ask is what, new Treasury Secretary Scott Bessent wants to do about the funding of the US government when he continues with Janet's policy. I would suggest Janet's errant policy of funding a lot in the bill market right at the front of the curve. And he will need to push or term out bond issuance towards more coupons later, probably in the term. And then the other thing we've got is a big challenge that's coming, starting around the middle of 2025, when the so-called maturity wall of debt that was taken on or termed out during the period of the COVID emergency is beginning to come due, and it will need to be rolled over. And that's going to sap up quite a lot of liquidity in markets. And I think that's an important thing to understand. Now, on top of those concerns, there are issues such as China, writ large. China, who knows what's going on there? I mean, the whole economic and financial situation is looking more and more of a mess. And you just got to look at the Chinese bond market to get, kind of spooked about developments. You don't see sudden collapses in the yield base of what is probably the most important bond market in the world, in 2 or 3 days. I mean, these are worrying signs. So I think the bottom line is, as regards liquidity, I'm realistic but getting a little bit more cautious. As regards markets, I mean, our view is that we're not going risk off yet. We still think that it's still a sort of benign-ish environment. But, the way that I've described that is to say, look, think of enjoy the party, but dance near the door. There are clearly risks picking up, and one's got to be very aware of those risks.
So let's step back and talk about what do you mean by liquidity? Do you have 3 factors in your global liquidity index: central bank liquidity, private sector liquidity, and cross-border liquidity? So the pickup in liquidity over the past 2 years, how much of that has been from central banks? How much from the private sector? If so, from where? From banks, from non-banks, private credit? And then tell us about what's going on in the cross-border world, which happens to be the name of your firm, Crossborder Capital.
Correct. Okay, well, let's take each one of those separately. What you've had is a clear stimulus from central banks. In fact, there's a chart that we can show, which is a heat map, which is basically looking at what central banks have been doing over the course of the last 3 years. And the tiles in that heat map, the red is probably by definition saying that what we've got is an environment where central banks are actually withdrawing liquidity from markets. You saw the peak of those sort of red hues on the chart around the middle of 2022. And then as we move progressively from left to right, you start to see the hues change from red towards green, green being loose or central banks beginning to inject liquidity into the system. And where we are now is a much more benign environment as of the end of November 2024, which is the latest data we have. But that is really telling us what central banks have been doing. Now, the private sector is a little bit of a mixed bag here, depending on which country you look at. If you look at what banks have been doing, banks have been slow to ease, but they're beginning to come to the party. And if you look at loan officers' surveys, they've basically begun to turn positive, more favorable on lending, really over the last 6 months. And that's gone very much against the consensus view that was still very much of the view that banks will be withdrawing credit, but they are coming back and they're putting liquidity in. That's generally a worldwide phenomenon. If we dig into the other element of private sector liquidity, which is the corporate sector and corporate cash flow, that's been particularly strong and noticeably in the US. So US corporations and particularly tech companies are throwing off a lot of cash. Now, part of that is actually an indirect effect through the US private sector of the very loose Fed policy. And what we've had is not just Fed spending, but we've also had a phenomenon which we call not yield curve control, where janitors basically funded the US government, increasing at the short end of the market. Now, the reason for citing that is that if you think about liquidity in broad concept, the way that we think of liquidity at least is to say that liquidity is defined as the pool of assets divided by their duration. Okay, so what you can see is an increase in liquidity if assets go up or if duration shrinks. And what we've had in the context of the US is that duration has come down quite noticeably. So janitors actually reduced the average maturity of the US calendar, the issuance on the calendar, by about 1.25 years since the end of 2022. On top of that, there's been massive bill issuance, as we know. So incoming Treasury Secretary Scott Bessent has got a big challenge because he's got to refinance in 2025 about 30% of the 28 trillion of marketable debt in the US economy. So this is clearly a challenge, but that's one of the reasons that liquidity has basically gone up. So you've had that element. The cross-border flow element has also been significant, but it's really been a big significance for the US. And this is something we need to get a handle on, because what we're seeing in terms of these cross-border inflows are very large, sustained, but rapidly moving cross-border flows, basically buoying up US assets. Now, this is something we've seen before. We've seen this movie. We've seen it in Japan in the 1980s. We've seen it in emerging Asia in the mid-1990s. And we've seen it in China in the wake of the 2008-9 global financial crisis. And these parties don't end well. Now, I'm going to come on to that later, but let's just stick with the script so far of what central banks are doing. Now, if I go to an earlier chart, which is looking at what the Federal Reserve is doing, and this is what we've labeled not QE. Now, as people will know, listening to the rhetoric that comes out of the Federal Reserve and the FOMC, the Federal Reserve is supposedly engaged in quantitative tightening. So they're supposedly taking liquidity out of the system. Well, their balance sheet is definitely shrinking, but what this chart is showing is the amount of increases in liquidity generating elements from the balance sheet. Now, this begins in 2019. You'll see the period of the COVID emergency where the Federal Reserve, these are looking at year-on-year increases in Fed liquidity, actually increased quite significantly. There was a period through 2022 where the Federal Reserve definitely did take liquidity out of the system. But look at what they've been doing recently, really through 2023 and through this year, where there's been a very significant increase, averaging probably at a year-on-year basis about 2 trillion, going in to markets. And this is basically because the Federal Reserve has been doing things like, manipulating the reverse repo tranche, changing the Treasury General account, bank term funding programs, these elements have actually been liquidity generating. But that is not the end of the story. And the other thing we've got to think about is the next chart, which is looking at what we call, again, somewhat flippantly, not yield curve control, yield curve control. And this is trying to assess in trillions of dollars the impact of Janet's change in the funding structure of the US economy. Now, what has happened, and this is somewhat arcane, so you'll have to bear with me, but broadly what's been going on is that a lot of funding, rather than being done at the long end of the market through 10-year coupons or 30-year bonds or whatever, has been done much more at the short end. So it's been done through bills, which are securities that don't pay coupons, that basically have a term up to 12 months, or they've been done in 1, 2, 3, 5-year coupon bills. Now, the reason that's important is that those bills in a collateral sense, or those short-dated bonds and bills in a collateral sense, have got much, much greater value. So credit providers are much more willing to lend against those. The other feature is that if you think generally in the markets, who buys those sort of instruments? It's the banks. Because if you've got a very loose fiscal policy and the Treasury is writing checks to the public and the public are building up their bank deposits, banks in the US have to find assets on the other side to match those deposit liabilities. And given the fact that a deposit liability can walk out of the door tomorrow, they want short-term duration matching. And so these types of securities are absolutely ideal for the banks to hold. The problem is, though, that if you're doing that, by definition, you're monetizing deficits. Think of a contrast where the Treasury is actually funding the deficit through issuing a 10-year coupon bond that will be bought by an insurance fund or a pension fund, for example, a life insurance fund or a pension fund, and that will come out of existing savings. It will not be monetized. What's going on now, there's a lot of monetization going on, and this is clearly a worry. What's more, if you get an unwelcome interest rate spike, it's going to cost Scott Bessent a lot more in the interest bill because he has no control over short-term funding. So these are issues we've got to be wary of. Next chart is just saying, well, add those two factors together, and what does it mean in terms of the stimulus that the US public sector, Federal Reserve and Treasury have imparted to the markets? Now, we all know and we fully recognize what happened during the COVID emergency, where there was a huge stimulus. And I'm not counting here fiscal spending. I'm just looking at two elements. I'm looking at the liquidity impact of what the Fed has done and what Janet has done through purely changing the term of borrowing by the Fed. On top of that, you've got to add the fiscal spend, but I haven't done that. This is the hidden element that we're measuring. So there's been a hidden stimulus of, a sizable hidden stimulus that we're talking about, of a magnitude like $5 trillion has gone in. These are big, big amounts. And as you can see from the chart, it's beginning to roll over. Now, the question is, number one, will the Federal Reserve continue to do not QE? Short answer is, I think it's difficult for them unless they actually formally stop their so-called QT policy. In other words, they've got to start moving towards balance sheet expansion again explicitly by building up coupons. In other words, if you look at the Treasury General account, sure, it can be taken down, but it's finite. And if you look at the reverse repo tranche, that's pretty much exhausted anyway. And then we've got the bank term funding program, which is now rolling off quite rapidly. So at the end of the day, what's happening is the ability of the Federal Reserve to do not is very limited now. Can the Treasury keep going? Well, Scott Bessent has been very explicit to say that Janet has spoiled the party, and he's, basically said that, what Janet's doing here is running a policy which is akin to an emerging market or Latin American economy. We've got to be careful what we say now because Argentina is now in the luxurious position of being a very good borrower, but running a policy that is more reminiscent of an emerging market than the US economy. So he really wants to start to push funding from what we can see towards the higher end. That will sap liquidity. His ability to do that, against obviously President Trump's wishes to get a strong stock market, probably going to raise some tensions. But this is what we've got to be wary about. That chart is going down. Now, if we move back to the global story, and that's a little bit later in terms of slide 10. What we show there is the global liquidity cycle, and the global liquidity cycle is still in an upswing. And partially what I've just said about the Fed and the Treasury, there's still liquidity that can go in, but our concern is that we're now losing momentum. And with the dollar being very, very strong, the ability of foreign central banks and foreign governments to ease liquidity is clearly a great challenge. So what we've got is a situation where momentum is likely to be slowing. So that chart, which we've been indicating and projecting, will peak in late 2025, may well peak in late 2025, but it may not, the black line may not go up to meet where that red dotted line is. In other words, you may get a bit of what's called a belly flop, maybe in swing parlance. You're going to get a small increase and then a roll over. That's the risk. So number one is there are challenges out there for the US. Number two, there are challenges out there for foreign central banks with the dollar. And number three, what we've got is a situation where more liquidity is going to be used for debt refinancing. And that's something I think is worth thinking about right now, because the big bogey that's hanging over markets and what's really troubling investors, I think, long term, is this big debt problem. Now, let's try and focus on the debt. And in fact, the next slide, which is, I think, in the pack I sent, slide 11, what that is looking at is some metrics for debt. Now, everybody talks about these throwaway terms of financial repression. They talk about debt GDP ratios, escalating. If we step back a moment, why is a rising debt GDP ratio necessarily bad? That's really a question we need to think about seriously. And why would financial repression, which people mean by financial repression getting interest rates below the rate of GDP growth, necessarily be a solution to all this? And what I'm really trying to pose in this chart is that those debt GDP ratios that you're looking at here, which people sort of extrapolate to the moon, they're not really telling us anything. Does it matter that debt GDP is 400% in Japan or 120% in the US or whatever the relevant figures are? Academics stand dance on top of a pin and say, well, okay, 90% is the critical threshold. Below that level, economies derail. Well, just look at Singapore or look at Japan. I mean, they keep going. They wake up every day and they still produce stuff. Economies haven't derailed. So debt GDP is not probably the right metric. And what I put on that chart as well is another metric, which is debt to liquidity. And the point that we keep arguing is, look, what really matters in a world of massive debt, because debt's never going to be repaid, of course, is it's got to be refinanced. And if it's going to be refinanced, you need liquidity. And liquidity ultimately is the balance sheet capacity of the financial system. So if you want to refinance debt, you've got to have that balance sheet capacity. And what the orange lines on that chart show are ratios between debt and liquidity for all these economies. Now, if you look at that, you can see there is some equilibrium level that they're all trying to search out. And basically, a mean reversion is underway. You can see the progress that Japan has made. You can see what's happening in the Eurozone. So despite the fact that we know that France's debt GDP ratio is exploding, I'm not saying that's a good thing. It looks against liquidity that the Eurozone is actually in a much better situation. If you look at China, which I fully admit is in a terrible state, against liquidity, the Chinese debt situation doesn't look that bad. Now, notwithstanding that, I would say to get back to equilibrium, China still needs to print or expand liquidity by about 30%, which is still a big ask. But generally speaking, this looks more manageable. Now, if you aggregate this on a world scale and look at the next chart, this is the key thing we think is important to understand. And this is looking at the ratio of all advanced economies' debt relative to liquidity. So what I'm saying here, bottom line is, it's all about refinancing. Tear out the economic textbooks that tell you that capital markets are here to raise new capital. What evidence is that? They don't do that. Capital markets are here to refinance debt. Something like 3 out of every 4 transactions in global financial markets involve a debt refinancing transaction. That's a big, big change from 30, 40 years ago when capital raising was important. So it's all about debt refinancing. In a debt refinancing world, what you need is balance sheet capacity and liquidity. This ratio tells you what happens. The dotted line is our estimates of the long-term equilibria, which is basically created by looking statistically at that data. The annotations on the top are referring to financial crises. If you move significantly above the dotted line, there is a refinancing crisis or a financial crisis generally, and you can see those annotated. If you're below the line when liquidity is abundant, what you see is asset market booms, and I'm trying to label those. And where we are at the moment is in a significant lower displacement where liquidity relative to debt has been significantly suppressed. For what reasons? Number one, because following the COVID emergency, there was huge liquidity thrown into markets. The second thing is because interest rates were hammered down to near zero levels, corporations and governments, for that matter, termed out a lot of their debt. So a lot of that comes due now from the middle of 2025 onwards, but it peaks in 26 and 27. And the reason that that orange line is rising back towards that dotted, the broken line in the middle, is because you're getting this debt maturity wall starting to come in, and that debt needs to come back and be refinanced. And that will suck up liquidity. And that's an important thing to watch. And that's one of the reasons that we are concerned about the outlook over the next 2 or 3 years, because there's a lot of debt to refinance. We're in a debt refinancing world. And if you want to contain this problem, central banks have got to start pushing more liquidity into the system. And the question to ask is, are they willing to do that when the rhetoric that's coming out of the Fed is they seem to want to continue this so-called QT policy? And that's really a big question. Now, what does that mean for the US and for the US bull market? And liquidity is critical in that dimension. Now, if we start to think about what went wrong in Japan and what went wrong in emerging Asia, respectively in 1989, 1990 in Japan, and in the mid to late 1990s in Asia, it was because a lot of capital went into those economies that inflated bubbles. Their exchange rates were under pressure, but they decided they would monetize the liquidity inflows. And the bubbles burst when, in Japan's case, they suddenly realized they got inflation. And in fact, Miyano, who was then the central bank governor, which I recall very well, suddenly said one day, we're raising interest rates because we got service sector inflation. Well, nobody in Japan had ever heard of service sector inflation. It wasn't even in the statistics. But they hiked interest rates and arguably too much and burst the bubble. In emerging Asia's case, the capital inflows were arrested. They reversed because foreign investors got spooked by the big current account deficits that were opened up when the economies were booming. Imports were sucked in, trade deficits widened, and investors got spooked and pulled their money out. Now, let's take a look at slide 13, which is what's happening to the US. Why have you got, and this is the critical question, US exceptionalism at the moment? Now, parce America's great ability to produce technology successes, everything that's good, okay? I'm not going to decry that. But the fact is, what we're looking at is not just American exceptionalism, it's fundamentally US dollar exceptionalism. And what we're seeing here is a lot of inflows into the US dollar for various reasons. And what this chart is basically illustrating are capital inflows into the US that we've tracked from the other side because US statistics, the TIX data, are not fully comprehensive. A lot of dollar inflows are not booked mainland US, they're basically booked in offshore centers. And so what we're doing is looking from the other side, from using our database on cross-border flows. And this is showing money flows into the US. And what happened was a significant transformation in the wake of the global financial crisis. First of all, because what we were seeing in that situation was changes in banking regulations. We got Basel III, we had Solvency II for the insurance funds. A lot more safe assets were demanded naturally after the crisis. And a lot of those safe assets were US treasuries. And so money winged into America. Then we started to see the Eurozone banking crisis that pretty much ended any thoughts of the euro being a major reserve currency. People moved into the dollar. Then we got Xi Jinping's anti-corruption drive, which led to capital outflows from China and money moving into the US dollar. And what we've seen sustained through this period is a significant inflow into US dollars and US financial assets. And if you look at the latest plot, post Trump's election, it's begun to accelerate again. So money is coming in, the dollar is firm to strong. Everything that Scott Bessent is talking about a strong dollar. That's what his policies seem to be, supporting. And if you look at the following chart, it's my favorite metric of the US dollar. This aligns exactly with what we were just looking at with capital flow. The inflection in capital flow is driving the real exchange rate higher. This is data from the BIS in Basel. This shows the real trade weighted exchange rate. And what it's showing is a trend change. Now, I would argue that uptrend that's occurred since 2008 is very much intact. Does not seem to be troubled or is being challenged, and it looks as if that dollar is going up further. And that is why capital is being sucked in. If you look at the following chart, here is the warning sign. And this is saying we've seen this movie before. US is again shown top left. On the top right is Japan. This is the real exchange rate of the yen. And what I've tried to highlight is what happened during the bubble years. Then we see China, lower left. Again, what happened during the bubble years in China. Then we see what happened in emerging Asia, again during the bubble years. And what happened, hasn't fully happened in China yet, but it's going to happen, is that you see the real exchange rate rising significantly and then it tumbling. And that's the concern that we've got to think about in the US. What could cause that? Could be that capital leaves suddenly because foreign investors get spooked. It could be that the Federal Reserve decides to hike interest rates. A number of things. But this is really saying is, and this is what I argued in my book Capital Wars a few years ago, the adjustment in the world economy comes through real exchange rates. Capital comes into an economy, cross-border flows, the real exchange rate gets pushed up. But governments don't like a rising nominal exchange rate. So what they do is they monetize the capital inflows. They try and keep the currency down. And what happens is you get the expression of that capital inflow coming not through real economy prices so much, but much more in financial asset prices. And that's the adjustment mechanism. And that's what's happening in the case of the US dollar. Why isn't the dollar going up even more? Because the Federal Reserve and the Treasury are easing, okay, and that's keeping a cap on the dollar, but the dollar is still going up anyway. How could have Japan avoided the bubble by letting the yen spike dramatically in the 1980s, but they didn't want to do that. So they monetized and created a bubble. Exactly the same in emerging Asia. They were tagging the dollar very closely. They didn't want to go up against the dollar, so everything was monetized. This is the danger we've got. So what we've got to look at is we've got to watch the dollar really carefully because this is the same script. It ain't happening yet, but it could happen. And that's the danger.
Hey everyone, hope you're enjoying the interview. Today's episode is brought to you by the Teucrium Wheat Fund, ticker symbol WEAT, providing investors an easy way to gain exposure to the price of wheat futures in a brokerage account. Wheat is one of the world's most essential commodities, and its prices can fluctuate due to factors like weather, geopolitical tensions, inflation, and global demand shifts. With the Teucrium Wheat Fund, you have the opportunity to capitalize on these movements. Learn more at teucrium.com and explore how wheat may fit into your portfolio. Again, that's ticker WEAT. This material must be preceded or accompanied by a prospectus. Please read the prospectus carefully before investing. To obtain a current prospectus, visit www.teucrium.com. The Teucrium Wheat Fund is a commodity pool regulated by the Commodity Futures Trading Commission and is not a mutual fund registered under the Investment Company Act of 1940 and is not subject to regulation under such act. Commodities and futures generally are volatile and are not suitable for all investors. Futures investing is highly speculative and involves a high degree of risk. An investor may lose all or substantially all of investment in the fund. Investing in commodity interests subject the fund to the risk of its related industry. Brokerage commissions and exchange-traded fund expenses will reduce returns. Teucrium Trading LLC serves as the sponsor of the Teucrium Wheat Fund. Pine Distributors LLC is the marketing agent for the fund and is not affiliated with Teucrium Trading LLC or any of its affiliates. We thank Teucrium for sponsoring today's episode. Show them some love by learning more at teucrium.com, where you can explore how wheat, as well as other agricultural commodities, may fit into your portfolio. Now, back to the show. Michael, thank you for that. There's so much there. I just want to explain a few terms for our audience here today. Janet Yellen, of course, is the current Treasury Secretary. She will be departing, and the likely new Treasury Secretary under Trump is Scott Bessent. Michael, so I think earlier you referenced the key point of liquidity, because people use that word liquidity so often, and it has very different use cases. Sometimes people are talking about liquidity when trading. If Apple, they can easily get in, $1 million of Apple in and out very easily. A much more illiquid stock, they have to pay a spread, or if they sell it over a few days. I think a lot of times the term liquidity can be self-referential. So if we are in a bull market, people say, why are we in a bull market? Well, because there's a lots of liquidity. But it's not as predictive. What I really like about your work is that you attempt to predict financial and monetary conditions by looking at cross-border flows, private sector credit conditions, and central bank liquidity. And you define your terms really well, and you focus on the ability of why liquidity is important is because it is needed to refinance debt. Debt is very rarely paid off. It is almost always refinanced. And when you have a financial crisis, it's because the debt can't be refinanced. If I'm a corporation, I borrow it at 10-year money at 4%. It's quite rare that I actually won't have enough money to pay the 4% coupon. What really happens is if I owe all the money and I'm not able to renew my loan. That is what causes financial crisis, when companies don't have the ability to refinance. Michael, I would say when I'm looking at American corporate conditions, credit is very, very easy. Yes, risk-free rates such as the Fed funds rate or the 10-year Treasury rates are a lot higher than they've been over the past 10 years. But the credit spread on top of that is extremely narrow. I think the investment grade corporate spread in the US is 75 basis points. The high yield spread is close to the lowest it's been since, 2006. Why is corporate credit so easy? Can it be explained by, I guess, you said private corporations are throwing off cash, there have been relatively few defaults, or can it be explained by liquidity?
Well, I think it's liquidity, but I think just to roll back a second on your terms, we're thinking about funding liquidity. That's what we're measuring. Okay, so it's the ability of corporations or businesses or households or whatever to fund themselves in markets. So that's funding liquidity. That's different from market liquidity. Market liquidity is what you referred to as the depth of transactions, the bid-ask spread. Can you transact in size? That's derivative from funding liquidity. So funding liquidity comes first. That drives market liquidity. Generically, if you think of the liquidity of a security, you think of the asset size divided by the duration, as I said earlier on. So if you think generically about whether liquidity can increase in the system, number one is, are assets increasing? Or number two, is duration shrinking or increasing? So that ratio is important to thinking generically about liquidity. But the two measurable concepts that we think of, number one is market liquidity. We have indexes of that, and we show that they follow funding liquidity. But everything I'm really saying now is focusing on funding liquidity. So that's really the key thing. Why credit spread so low? I would argue is because corporations have got so cash rich. There's an awful lot of cash flow going through the US economy, is what we measure. It's one of the reasons the dollar is so strong, because you've got a very healthy cash flow environment, and that's normally a prerequisite to a strong dollar. So everything lines up in that respect.
So your thesis on why liquidity might begin to ebb in 2025 and 2026, how much of it is the fact that there is a lot of refinancing needs for corporations and households? People in 2022 said the corporations need to refinance. We now know they were wrong. Like, so many corporations borrowed very long-term money in 2020 and 2021, and the ones that didn't were able to very easily finance their needs through alternative solutions such as private credit. So the gap wasn't that big in 2022, 2023, and 2024, and the small gap has been plugged. But you're saying there's a much, much bigger gap on the horizon. How much liquidity do you think is needed to fill this gap? And also, is that the only reason that you think liquidity could begin to ebb, or what are the other reasons, perhaps?
Well, as I said, I think there are a number of challenges. One is, let's think of the supply of liquidity, which is really coming from the banking system, private credit, etc. plus the central banks, and I must add in as well, obviously the US Treasury with what we've said is not yield curve control, yield curve control. These things are clearly critically important. But what I was trying to identify was that the Federal Reserve is kind of running out of road in what it can do in terms of the not QE concept. They've got to start to shift towards formally ending QT and get their balance sheet expanded. I mean, it's in my view, it's crazy for a central bank to oversee a shrinking balance sheet when the financial system, which needs to roll over debt, needs an expanding financial liquidity pool. They have to do that. If you look within the markets, you're starting to see increasing signs of tension, and you can see the signs of tension if you look at the spread of SOFR rates over Fed funds. They should be in a normal range, but they're beginning increasingly to blow out. Now, we know that there are always quarter-end challenges, but looking through that, I mean, what you've had, I think I'm correct in saying, is so far this year, you've had 77 days when SOFR rates have spiked significantly above, outside of a normal range, away from Fed funds rates. But 34 of those have occurred since the end of October. So we're starting to see more and more tensions in the markets. And I think the Federal Reserve has got to start addressing this problem, pretty quickly. We know the Treasury General account is bloated. It probably needs to be run down. But there are other things they need to do because that's only a temporary respite. And coming back to Scott Bessent, he needs to think about whether the Treasury is going to continue to fund through bills. Bills are 22% of total debt now. The normal range that we've been guided to is 15 to 20, so it's above that threshold. It's except it's been a lot higher than that. At times it was 40%, but that's not a great recipe for funding success. What you need is you probably need to keep the current level running to keep the stock market up. So around these levels, maybe even pushing it out slightly. But that's not the rhetoric that's coming out of his mouth right now. He's saying that what Janet was doing was actually bad and we ought to be changing towards more coupons. But more coupons will sap liquidity. More debt refinancing will sap liquidity. So where is the liquidity coming from? And then we think, well, maybe somewhere else in the world, but the dollar is a wrecking ball that stops foreign central banks easing so easily. Just look at currencies around the world. How many central banks really want to cut interest rates when their currencies are tumbling against the US dollar? This is a concern. And the biggest problem by far in that regard is China. Now, I just want to say something about China because China's absolutely important. It's the elephant in the room here. And it's probably, working up to some major, catastrophe or major inflection at least. If you look at the slide I put in the pack on slide 16, this is looking at, I think, a sort of worrying development. Because what that worrying development is showing is the black line is PBOC liquidity injections into the markets. Okay, so this is their open market operations, and it's a rolling figure, and it's something that we've looked at for years. And the way that we understand the Chinese financial system, and it's still basically a state-run system where the state-owned banks are critical and the PBOC is critical to the whole tempo of the economy, is if they change liquidity injections, it feeds through significantly to change the tempo not only of the Chinese economy, but also the tempo of the world economy, given China's large economic footprint. Now, what you can see in this chart is the black line. Well, it's volatile, it goes up and down, but that's Chinese open market operations, their liquidity injections by the PBOC. But lately it's come thumping down. And one of the reasons that that's going on is the Chinese are trying to target the yuan against the US dollar. And that's what they've been doing, through much of the last few years. When you've got a strong dollar, this really, China is being impaled, on the spike of a strong dollar here. And that's the problem they had. If they want to maintain dollar parity, what they've got to do is to keep tightening monetary conditions. And that's what you see. Now, we've pushed forward that black line by 3 months. Now, this is suggesting it may be a predictor, and I'm not trying to forecast here, but I'm just giving a warning. The orange line is our nowcast of daily world GDP, and that's done through an AI system of actually looking at tracking commodity prices, credit spreads, currencies, trade-sensitive currencies around the world, and it's saying, what does that really tell us about world GDP? And we align it with other nowcasts and and actual data, hard data. And what it's showing is that seems to move pretty closely, I would argue, with Chinese liquidity injections by the People's Bank. China is an important economy. The PBOC is critical to the tempo of that economy. And if the PBOC is sitting on the brakes, that's bad news for the world economy. And so what we may be seeing here is a slowdown. Now, go to the next chart, take a deep breath before you do that, and start to contemplate what is going on, what on earth is going on in the Chinese bond market. Now, Wall Street, without any question, is the world's most important stock market, and it's become even more so this cycle. China has the world's most important bond market because it's the world's, let's say, most integrated economy. China trades with more countries than anybody else. It's a big economy, a huge manufacturing, behemoth. And what we've got to understand is what's happening in the Chinese system. This is their benchmark 10-year bond. What is going on there? It's falling off a cliff. And if you look at that, that's not because of rate expectations collapsing. It's because term premia, the black line, are going down fast. Now, why are term premia going down rapidly against a backdrop where in most other bond markets, term premia are going up because of all the coupon issuances out there? But in China, they're plunging because people need safety. They're getting really spooked by what's going on. This is debt deflation writ large. Okay, economies, financial systems cannot stomach debt deflation. There has got to be a change. And that change must be that China addresses its debt problem and monetizes significantly. Every other economy, Japan, emerging Asia, Scandinavia in the early 90s, America in the 90s, have all monetized to get out of big debt problems. China is no exception, okay? China is no different this time. It's got to do the same thing. And that means they've got to devalue the yuan somehow. The question is, what do they devalue against? Is it just the US dollar, or more importantly, is it gold? And I think what they're doing is they're devaluing against gold. Now, herein lies the prospect of a deal. And this is why I think it's important for Trump and Scott Bessent to keep the dollar elevated as we go into the front end of next year, because it gives them huge negotiating power. If you're talking tariffs, much better to do that against the background of a strong dollar than a soft dollar. They want the dollar strong, I think, because it gives them huge muscle internationally. I'm amused by the fact that when Trump came to the opening of the Notre Dame, it was very much like all these European politicians were went to sort of pay homage to the emperor. It was extraordinary to watch. And, we've even seen that with the Canadian Prime Minister immediately coming to see Trump. Trump is important for the world economy in a way that no US president has been for a long, long time. He matters what he's going to say. And I think a strong dollar is part of that policy, at least in the near term. Despite what Trump says he wishes, I think a strong dollar is there. Therefore, they need it to negotiate. China wants to do a deal, in my view, and that deal will probably be devalue against gold. This is maybe a maverick view, but let me say that. Devalue significantly against gold, the yuan. Try and keep as best as possible the US dollar yuan cross rate near where it is or around where it is, so save face, and let the dollar gold price devalue significantly.
Michael, why do you say that the Chinese bond market is the most important bond market in the world? Earlier, we showed a chart that the US debt to GDP ratio is quote unquote only 125%, which is, of course, compared to historical standards, very high. Whereas in China, the debt to GDP ratio is 270%, 280%. However, I believe a lot of that is state, the banking system lending to construction firms rather than national debt, but I could be wrong. So why is the Chinese bond market so huge? Because to be honest, I rarely hear about the Chinese bond market, but I and other people have noticed that yes, the Chinese bond market yields have absolutely collapsed, as you showed, and at the longer end of the yield curve, Chinese yields are lower than Japanese yields, which really is wild to say.
Well, I mean, to turn it around, why is the debt GDP ratio important? Why is 100%? Why does it matter? Why does 200% matter? Why does 300% matter? I mean, look at Singapore. I think Japan is up there at near 400%. These economies keep running. They can keep financing their debt, but it's all about financing the debt. It's not about repaying the debt. I'd come quietly if you say, well, okay, the debt GDP ratio is measuring the debt repayment potential, but debt's never repaid. Let's get real here. The can is kicked down the road. No one ever pays their debts back. Okay,
Yeah, Michael, I'll get real with you is that I happen to agree with you. I mean, there were a lot of very smart economists who 10, 15 years ago predicted that if the US debt to GDP ratio hit a certain threshold, I forget if it was 95%, 100%, 105%, that growth would suffer and that there would be drastic financial consequences. That hasn't happened. I mean, I do agree with the late and great Charlie Munger that if you think debt and GDP can go to, 20,000%, you probably also believe in the tooth fairy. So I do think there are natural limits. But yeah, broadly, to be clear, my own views, I do agree with you that it is the refinancing capability and that it is about how much money there is relative to the debt rather than debt to GDP.
Yeah, I mean, is the financial system going to fall apart? No, it isn't. Just think back to, go back to year 1900, okay? What's happened to the dollar since 1900? It's devalued dramatically. I mean, whatever, a dollar in 1900 is probably worth 12 cents now in real terms. Okay, fair enough. Okay. If we go to, year 2500, what's the dollar going to be? How many cents is it going to be? They're going to keep devaluing it. Okay, that's the point about paper money. It's devalued. The can is kicked down the road. That's what's going on again now. We've got to be real to that. That's why we keep saying we're in a period now where you've got accelerating monetary inflation in terms of the trend. Investors need monetary inflation hedges in their portfolios. And what better, things like gold or Bitcoin. These are monetary hedges you need to take. But the point is that the big problem out there is China, because China is suffering debt deflation. Okay, this is when debt really matters, is if you're getting debt deflation because you're getting a huge burden on the economy. The economies can't stomach this, and so they've got to get out of that, and they've got to print money. Okay, like it or not, that means devaluing the currency. Now, I think there's something going on with the Chinese gold market. Maybe I'm wrong here, but this is the thing to start thinking about. Okay, and gold as a monetary hedge isn't necessarily a high street inflation hedge; it's a monetary hedge, and this evidence for the bond market is telling us something really bad is going on.
And so, Michael, people hear China would, people might assume that China wants a strong yuan, the Chinese yuan, but actually, it's for exporters. It is quite good to have a weak yuan for China, because that way they can cheaply produce stuff and sell it to the rest of the world. So the U.S. wants a strong dollar, where but China also wants a weak yuan. So doesn't the U.S. and China want the same thing and is trying to weaken the yuan? So, for example, over the past 3 months, the yuan has weakened from 7 yuan to the dollar to 730 yuan to the dollar. Do you expect that to continue? And also, why is China trying to devalue relative to gold, which some may say is a barbarous relic, which did run the monetary system before, the 1930s, as opposed to devalue it to the current monetary standard, which is the dollar?
Well, I mean, the interesting point is why do economists talk about the barbarous relic? Okay, and why do governments keep telling us that there's nothing in gold? The gold price seems to keep going up. Gold has been demonstrably over decades, centuries, millennia, a wonderful monetary hedge. Why are they saying this? I mean, it does what it says on the tin. And the point being is that when we talk about a rising gold price, what we really mean is that paper money is devaluing against gold. Gold is the pole star in the sky, which we should be navigating, our economic and financial futures against. The gold price really stays where it is. Everything else goes down. And that's the sort of the firm point or solid point. Now, if we look at if we look at what's happening, why does China need to get rid of its debt? Because basically, if you think about debt GDP, and let's think about debt liquidity. Now, all money that is anywhere has got to be somewhere, agreed. Okay, so if it's not in GDP, it must be in financial assets or the asset economy, and therefore, debt to liquidity actually embraces the debt to GDP ratio. So, in other words, think about liquidity as funding both GDP and funding financial asset purchase. Okay, so there's no other money around. You've got those two pools. So debt to liquidity already embraces debt to GDP in many ways. So even if you get no high street inflation and no growth, okay, your debt value in real terms is still devalued because your financial assets are going up. So you can still afford your net worth is increasing. Debt is fixed in nominal terms. So if I'm sitting on a Bitcoin or a piece of gold, okay, and I've also got a loan to you, and Bitcoin and gold go up dramatically, my loan to you is still denominated in dollars at the same level, but the assets I've got to offset that go up dramatically. Okay. So my net worth has gone up. And that's why looking at gold is a very good way of actually understanding this process. It's one benchmark, it's a preferred benchmark, but it seems to do the job. So that's why it's going. That's why I'm thinking about that. So devaluing against the dollar doesn't. Is not really going to tell us anything about the worth of Chinese debt, particularly if you've got debt which is denominated in dollars anyway, because the Chinese have a lot of.
Relative to its for a quote unquote emerging market, I believe that China, as a percentage of its foreign or of its debt, is a lot of it is denominated in yuan. Definitely a lot in terms of a nominal amount. Definitely a lot is denominated in dollars. But why not weaken the yuan to nine yuan per dollar? That would really, I mean, you think BYD is making a lot of electric vehicles now. That would really get things going and maybe get China out of this debt deflation trap. Is it because China doesn't want a weak yuan, or is it because the US doesn't want a weak yuan?
The first thing to say is that if you take the exchange rate, China really has three exchange rates notionally. Okay, there's an exchange rate which would equilibrate trade. Okay, some sort of purchasing power parity thing for Chinese exports. Now, I'll come quietly and say probably on that basis, because Chinese costs are so low, you could actually argue technically that maybe the yuan is cheap. The exchange rate also measures two other things. One is it measures capital flows. China has notionally has capital controls. It's a very leaky system, but they have capital controls. If they took those capital controls off, what would the yuan do? Would it appreciate or would it devalue?
Devalue, maybe?
I think it would devalue dramatically. Okay, I think everyone else would agree that. So that's one exchange rate, which you've got to contrast with the other one, which is a trade competitiveness one. And then you've got a third exchange rate, which equilibrates the entire economy, because essentially current account deficits are not about trade competitiveness; they're about flows of funds in the economy. Okay, that's what we know from looking at macroeconomics. So essentially, three exchange rates. One which equilibrates the economy, which determines debt deflation. And that, I would argue, the yuan is still too expensive. And that's what the markets are telling us. That's what the bond market's telling us. That's what downward pressure on the yuan is telling us right now. You've got a trade competitiveness one, which I'll come quietly and say, well, okay, if economists tell me that Chinese electric cars are really competitive and the yuan needs to go up, I'll come quietly and accept that. And then you've got a third one, which is all about capital controls. Now, two out of those three suggest to me that the yuan has got to devalue dramatically. And why don't they inch towards a lower yuan dollar? For the simple reason that there'll be a huge exodus of money wherever they can through the exchanges, because Chinese do not want to see a devalued currency. Why is there huge gold buying going on in China right now? Because they're scared about this prospect. I think this is what all these statistics seem to be telling me anyway, that there's a big problem out there. And I think that maybe the incoming Trump administration wants to hold China's feet to the fire here and say, well, okay, this is what we've got to do a deal. America and China have to do a deal. There's no question about that. I mean, I wrote about in this book, Capital Wars, a few years ago. This is what I wrote about. China is a dollarized economy, like it or not. Okay, it is hugely dependent on the dollar. It cannot get off the dollar hook however much it wants. It has ambitions for the yuan, but it's hooked on the dollar. And that's the problem. The great paradox in economics is whenever China's trade surplus expands, the dollar goes up, because China is like California, it earns a lot of money in dollars. And it doesn't recycle those as efficiently back into the world economy. So you basically get problems in terms of demand and supply imbalances. And that's part of this problem as well. But, it leads us on to say, what are you invested in the future in terms of the trends? This is not a short-term recommendation, it's a long-term recommendation. You need to have more gold in portfolios. You need to have more Bitcoin in portfolios from a longer-term standpoint. Is Bitcoin elevated right now? Sure it is. Okay. I thought maybe we'd see a correction already. There's a lot of euphoria about it. I'd prefer to buy it when it's lower, but I've got to accept the fact that the trend is up there. And that's what we've got to see. We do an analysis, and in fact, it's on slide 18, which is looking at what drives Bitcoin. And lo and behold, global liquidity is the important factor. And what we show in this chart is, and I'll explain what's going on here, the orange line is the 6-week change in the value of Bitcoin. Okay, the black line is the 6-week change in global liquidity advanced by 13 weeks. Now, let me just explain what those two weekly data points are. Why take a 6-week change on a 5-week, a 4-week, a 3? Purely because, I mean, you can do whatever you want, but this is to take the noise out of the data. There's a lot of noise in economic and financial data. This just takes the noise out and tries to look at the underlying currents, and that's why I've done it. Could I have used an 8-week? Could I have used a 3-month? Sure, okay, but I've done 6 weeks, so hey, what the hell? This is looking at the 13-week lead time. Why 13 weeks? Because statistically, that's what comes up. And I don't know why that's the case, but that's what's going on. And what it's showing is a pretty decent correlation between these two factors. Looks like liquidity is very important. Now, if you look at the next point, and this is where statistics, I'm going to breeze over this quickly because it's statistical, but what we've got are two statistical tests of that process. The bars are probably much easier to explain, and what they're saying is this is the correlation coefficient of liquidity against Bitcoin, with liquidity advanced by that time, and the impact on Bitcoin is shown in terms of weeks, and those are the correlation coefficients. And you can see it's bunched around. I mean, there's obviously random noise in that, but it's bunched around sort of 11, 12, 13 weeks, and that's what we come up with. The black line is something called a Granger causality test, which is best way to read that is to say when that Granger causality line flattens out at 0, you're pretty much sure that there is one-way Granger causation between global liquidity and Bitcoin. So in other words, it's driving Bitcoin, Bitcoin's not driving it, and it seems to be a significant process from that time point. Now, this is not a recommendation. This is not saying, scientifically, this is going to, recur in the future. It's saying what we've had in the past. And the next chart says these are the influences that we've worked out on Bitcoin systematically in terms of the drivers. Okay, so this is a statistical analysis we've done. We've done it a few times before. We've published it on our Substack, Capital Wars. And what it shows is if you do a variance decomposition of the influences on the systematic influences on Bitcoin, what you find is you get these factors. Now, biggest factor, 40%, is global liquidity. But what we've got to recognize as well is that Bitcoin is also influenced by investor sentiment. It's a very sentiment driven asset. We know that, okay? But about 1/5 of the movements in Bitcoin, the systematic stuff at least, is we ascribe to risk appetite, and we measure risk appetite by the changing asset allocation of US investors in general. So things like using surveys, we actually use hard data on asset allocation, but you can use things like investor intelligence or any of these similar surveys to gauge that. And then the other two elements are basically gold. What that's saying is that the gold price and Bitcoin are co-integrated. They move very closely together. But actually, interestingly, I won't go into this in detail, but what it's really saying and what those two factors are telling us is statistically there's something called an error feedback mechanism. And what that tells us is that there's an equilibrium level between gold and Bitcoin, a ratio or portfolio allocation that investors are sort of moving towards. And whenever one gets out of line, the other redresses it. So it's not unusual after you see a big race up in the gold price to see gold suddenly coming back and Bitcoin zooming, which is what we've seen in the last few months. So the fact that gold has gone down and Bitcoin zoomed up is actually just this equilibrating process going on. So what it's saying is intuitively, this seems to make a lot of sense as to what's driving Bitcoin. And therefore, this is one global asset that people look at now increasingly. Global liquidity is important. And so we've got to understand these currents about what the Fed is doing, what the US Treasury is doing, what the People's Bank of China is doing. Maybe we care a little bit about the European Central Bank, but they're really
Bank of England.
Well, I mean, that's not even bother really. They don't really trouble the score. I mean, it's the Bank of England signalled a big change, after the Liz Truss budget, where it showed that how policymakers will move with alacrity when they need to. They switched from a QT to a QE policy overnight when it mattered, because the most critical question for a government is the integrity of the sovereign bond market. Forget all these remits about inflation and unemployment. What really matters is the treasury market. If the treasury market goes awry, they will come in quickly to address the problem, which is why I think the Chinese bond market is signaling something really very important right now.
Let's talk about the monetary plumbing and the Federal Reserve in particular. To define a few terms you referenced earlier, the TGA, that's the Treasury's general account with the Federal Reserve. And as they spend that, as that TGA goes down, they are spending money and putting it into the economy and or financial system. Then there's the reverse repo facility, which was over in the trillions, and that has gone down. And the reverse repo facility is basically a deposit facility that the Federal Reserve has where money market funds can park money with the Federal Reserve and technically, quote unquote, lending the Federal Reserve money by an overnight. The money market funds are buying treasuries and assets and selling them back to the Fed every single day and renewing that. And what you refer to, a lot of the increase in Federal Reserve liquidity, Michael, I think since 2022 has been money coming out of the reverse repo facility, which causes
Correct.
general liquidity to go up, and they also put that money into the treasury market. And they can't own 10-year treasury bonds, or most money market funds can't. But they can buy treasury bills, and this is when you talked about Janet Yellen. She issued a lot of more shorter term debt rather than longer term debt, and that in itself is, to a small degree, is inflationary and stimulative to the financial system, because a 10-year note or a 30-year bond requires a lot more balance sheet capacity and is a lot more risky than a
Correct.
3-month treasury bill. Earlier, when you said coupon, that is basically paying interest. So if interest rates are at 4%, and if you buy a 10-year note, treasury note, you get 4% every year. So maybe $2 every 6 months. However, treasury bill does not have that coupon. What you just buy is a 1-year treasury bill. You buy it for $96 and then you redeem it for $100. So it is extremely money-like. And as you referenced earlier, it can be used for collateral because it is a lot less risky than a 10-year note and a lot less volatile, just mathematically. So, Michael, I might say that the money that has increased liquidity was already there and was already created, whether by the Federal Reserve or Fiscal in 2020 and 2021. It has just been drained out of the system. And now I believe the reverse repo facility is, quote unquote, only $180 billion. So you're not going to get that increase in liquidity. And, I might quibble with the terms like not shadow quantitative easing, because the money was already there. But how is the Federal Reserve going to increase liquidity from here? Because it can't rely on any of these, let's call them tricks and games anymore, where there's trillions of money locked up in a special safety deposit box that you can they allow to leak out. They have to ultimately create new money. And Michael, the Federal Reserve has been doing quantitative tightening, reducing their balance sheet. At what point will they stop? Do you think they will stop quantitative tightening in 2025? Do you think they will start doing quantitative easing in 2025? And an actual easing of definitely expanding the money supply and trying to lower bond yields. And also, I noticed, we're recording the day after the Federal Reserve. Interestingly, they decreased the reserve repo rate by 30 basis points instead of by 25. So it's now at the lower end of the Fed funds floor. So I don't know to what extent is that going to hasten money coming out of the reverse repo facility.
Well, to answer the last question first, the reverse repo is pretty much drained anyway. We're down to about 150 billion, and it's been in the trillions, so it's more or less empty. I don't think the move reverse repo was to do that. The reverse repo rate is really the anchor rate in the system, and what they're doing is, I think, trying to smooth over the year end. Every quarter end, there's volatility in the money markets and the repo markets, and I think by basically reducing the reverse repo rate, they're going to try and keep that volatility down. Good luck with that, but there will be some. But hopefully they do that. I think that's purely a technical thing. I wouldn't read too much into it. But to come back to the question about will they undertake QE? Will they stop doing QT? My view is I think they have to. They've got to do that. That's a danger point. We've got to be very alert to. And I think a lot of the debate over during the last FOMC, particularly the presser, was whether the Federal Reserve was hawkish or dovish. And I think at the end of the day, I'm sort of slightly confused about what the message is. I mean, my view is that, I think Jay Powell is dovish. I think he's dovish on inflation. I think, as my former boss Henry Kaufman so succinctly said 2 or 3 years ago, that any central bank that uses the term transitory for inflation is a central bank that doesn't want to tighten. And I think that we've seen that absolutely, nailed on over the last few years. They don't want to tighten. I think the fact is that with the economy booming, or certainly with asset markets booming, they should be prudent and actually not cut interest rates. And I think that should be the message that Scott Bessent delivers, or tries to deliver them. I think that if I was in their shoes, I would be showing Chairman Powell the exit pretty quickly. I think they need a more robust and more hawkish central bank governor in there who's got credibility on inflation. Inflation is not a serious worry, but it's a nagging worry, and I think that the markets need somebody serious there to actually address that. Now, on the question about QT and the technicalities, I think the danger is, and this is why I can't really see whether the Fed is trying to be easy or whether it's trying to be loose. I think technically they seem to convince themselves that liquidity doesn't matter, and they have to get, simply for arithmetic purposes, get the balance sheet down, and they had to reverse this QE process and basically get back to scratch with a QT policy. I think that's madness if they keep going down that route. The markets need liquidity. This is the key thing. This is the lifeblood of a financial system. They can't keep doing this. We know it has costs, and we know it has costs in asset inflation. That's clear. But the fact is, we've got to address the debt problem. The more that you cut interest rates, the more that you incentivize debt. The reason we got into this mess was really coming back to the door of China back in 2001, where China joined the World Trade Organization and imparted a huge deflationary shock to the world economy because Chinese goods were cheap and they dumped a lot of goods in the West. That was probably a foolish policy to let them in on those terms, but we did it. And as a result of that, central banks panicked. They thought they were seeing deflation. They were actually seeing cost deflation, which is not such a bad thing. And they slashed interest rates to near zero. And what that did is incentivize this huge, huge debt buildup. And we're facing the consequences ever since. We've got to get out of debt, but it's really difficult to do it now. So what you've got to do is to roll it over, kick the can down the road. You've got more debt coming because of aging demographics, of the welfare bills, Medicare, Social Security, and now defense coming on top of that. And ultimately, if they kick the can down the road, that's monetary inflation. I think we're in a monetary inflation world, not necessarily a financial repression world. There will be financial repression, but it's really about monetary inflation. And that's why you need to get monetary inflation hedges in portfolios.
So, Michael, I want to connect a few ideas. About 30 minutes ago, you talked about SOFR, secured overnight financing rate, relative to the federal funds rate. So both are basically risk-free rates, so they normally trade on top of each other. But there is a small, 5 basis point spread, which is nothing to anything else. But for this minute mechanics, 5 basis points is actually a lot. And I know this from Joseph Lang, that Roberto Perli, he Federal Reserve figure, his measures of ample liquidity, i.e., if there's ample liquidity, you can continue to do quantitative tightening. All measures, and I don't really know what they are, to be honest, are indicate ample liquidity except for SOFR over Fed funds. And that is the one measure that there actually could be close to a time where they have to stop doing quantitative tightening. So perhaps the 5 basis point adjustment in the reverse repo rate to align with the lower end of the Federal Reserve target range, perhaps that is so the Federal Reserve can continue to do quantitative tightening, and they can go, see, none of Roberto Perli's indicates of reserve scarcity have been triggered.
You could be right. That could be some of their thinking. I mean, I think the concern would be, as if you think of a pipeline of liquidity, the repo market is really at the front end of that. And this is what SOFR Fed funds spread is indicating: tensions at the front end of the pipeline. The markets, in other words, Wall Street, is really at the end of the pipeline, the other end of the pipeline. So it will take some time before those effects really spill through or feed through. So this is why we're worried, because we're looking in anticipation of future problems. And as I said, sort of right at the beginning, I mean, if you want to understand, Wall Street today or Bitcoin today, what you really got to be thinking about is not today's events, it's what's really going to happen in 9 months' time. And this is what we should be focusing on. What does the economy look like? What do markets look like? The summer, early fall of 2025. Because that's what the markets are, forward discounting mechanisms. They're looking forward. And that's what we've got to try and understand. And to my view, or my way of thinking, I think that's where the pressures start to build, because we've got, looks like a loss of momentum in terms of liquidity generation. We've got big uncertainty in China, and we've got this debt wall which is coming up. Now, as I say, I'm not bearish yet, but I'm inching towards the door. But that's for sure.
But Michael, why does the central bank, the Federal Reserve, have to drastically increase its liquidity again in order for the system to work? Why can't what has been happening over the past 2 years occur, where private sectors are expanding their balance sheet and levering up, and banks are buying treasuries, and the rest of the world is buying treasuries, but the Federal Reserve is actually reducing its balance sheet, or maybe even continue to hold flat? If as long as there's no reserve scarcity and we don't have a repo crisis like we did in September 2019, why can't JP Morgan and Bank of America and the People's Bank of China, or excuse me, the Bank of China, the commercial banks, and European commercial banks just buy treasuries and private citizens? Why can't we let the market function? Why does the Federal Reserve have to be back in the game of monetizing U.S. debt?
Well, because I think think of it, if the financial system is a super tanker, the Federal Reserve is the pilot, or the pilot boat, and it's really steering the overall system. And if the Federal Reserve is going one way and the markets are going the other, that's unsustainable. So I think the Federal Reserve has got to give guidance in some, whether it's through words, which maybe in fact they overdo that now, but much more particularly in terms of liquidity in the system. If they're pushing liquidity into the system by definition is expanding. If the Federal Reserve reduces liquidity because of the big multiplier effect on Fed liquidity, it's so important, the system runs the risk, what isn't necessarily going to happen, but it runs the risk of retreating or collapsing around diminished Fed balance sheet, and that's really the risk. What you need as well is obviously need collateral to expand, but if the Federal Reserve is reducing its balance sheet, is the pool of collateral likely to expand at the same time? And I think it's unlikely. So it's not impossible, but we've got to think about risks here, and that's really the thing. I mean, there is around the FOMC meetings. I mean, it's a circus, a pantomime, and the Federal Reserve has created this, and it's really, if you like, it's almost like going back to Imperial Rome with bread and circuses. The FOMC, the presser is the circus, and the bread is basically forward guidance. At the end of the day, this is sort of mixing my metaphors. This is people dancing on the head of a pin. And what really matters is the amount of liquidity being generated in the system. Debt is the big bogey. We've got to refinance debt. If we don't refinance debt, there'll be a financial crisis. You can spot financial crisis sometime ahead by looking at that imbalance. But the straws in the wind are things like problems in the SOFR Fed funds spread. That's where you might start to see that early.
If the
But
Federal Reserve doesn't stop doing quantitative tightening in 2025, or doesn't even do quantitative easing in 2025, you said we'll have a financial crisis. What does that mean? Does that mean the 10-year bond is going to spike up in yield? Does it mean risk assets, stocks, and Bitcoin and gold go down very much? Because I think that the U.S. Federal Reserve cares about financial conditions and credit spreads, and if those blow out, they will be attentive to that. They care about that in addition, of course, to their dual mandate of full employment and stable prices. However, I don't think the Federal Reserve is terribly concerned about a stock market going down a lot, at least from the very overheated levels right now. Or if Bitcoin went to $50,000, I don't think Jay Powell would shed a tear. That's my view. Do you agree?
Well, you're probably right, but I think they should be alert to these things, because these are all part of the general consensus of what financial conditions or monetary conditions are. They've got to look at this. They certainly should be looking at that. And it may be that Jay Powell doesn't worry too much, but I think President Trump would definitely worry a lot if you saw a lot of those gyrations in markets. But I think that at the end of the day, we've got to be alert to these risks. I'm not saying they're going to happen, but I think there are clearly risks out there. What would happen in a financial crisis? As I've argued before, I mean, almost every financial crisis you've seen over the last few decades has been a debt refinancing crisis in some form, and that's what we're talking about right now. And if you want to look at what happens, take a look at China now, because look what happens. What's happening to the Chinese 10-year bond? Yields are collapsing, bond prices are spiking higher because people will go into these safe assets. There'll be massive deleveraging, so people will be selling whatever assets they've got. If gold is held on leverage, if Bitcoin is held on leverage, they will go down dramatically as well until the leverage clears. But make no mistake that the solution to all these financial crises is more liquidity going in. the central banks and the finance ministers do not want the financial system to end, to implode. The only thing they've got to get these things back on the rails again is to pump in more liquidity. How many times have we seen that over the decades? This is not rocket science. This is all they can do. So they've got to pump more liquidity in. So if you think there's a financial crisis coming, I mean, it's down on the sidelines. But when you go back, just buy these monetary inflation hedges. This is what's going to work in the long term. My view is that global liquidity is going up over the medium term because debt is going up. Debt we know is rising, and Parche, Doge, or whatever Elon Musk can muster up. The fact is that I rather think that Social Security, defence, and Medicare are much bigger challenges to him. That he can't arrest those trends. And this is the generosity, the welfare generosity of governments in the past few decades. We simply cannot afford the bill now of a lot of these systems. America is in a much better position than most other countries here, make no mistake. But it's got the reserve currency, it can fund internationally. But a lot of other countries are really in a big mess. You just start to look at Europe and how's Europe? I mean, the challenges Europe face are just eye-wateringly large. They've got aging demographics. They don't know where they're going to get their energy from. They've got to now suddenly start buying debt, defense, or paying for defense. I mean, these are big issues. And what's more, maybe a clever thing to do is for Scott Bessent to say, well, okay, if you want defense, start buying more US Treasury bonds. Maybe that's the answer. A great deal there. But I don't want to give him ideas.
Michael, so explain where you are. Connect these ideas about where you think we are in the cycle, because in the beginning you said party on, but be close to the door. And before we started recording, you said that you think the markets are in the calm phase. And I believe there are 4 different phases in terms of cycles. There's the turbulence phase, the rebound, the calm, and then the speculative phase. So is the speculative phase after the calm phase? Because if we're still in the calm phase and we're not yet in the speculative phase, then that's bullish. And you're saying that things can get way more bullish than we already are. Or is turbulence ahead? Like, where are we in the cycle? And just how do you connect that? Because you say you like gold and Bitcoin as monetary hedges, but I know you said you think liquidity will increase. But it seems to me, I mean, there would have to be some sort of monetary accident or crisis in order for the Federal Reserve to start quantitative easing again. And I just want to get a sense of your specific time horizons and on liquidity, and how that specific time horizon on liquidity ties to your view on risk assets and the
Okay, right. Let's be clear. The trend in liquidity is going up over the long term, right? That makes me very bullish of things like Bitcoin. It makes me bullish of the stock market in the long term, and it makes me very bullish of gold as well. So I think all those assets are fantastic assets from a medium-term perspective. We are going to hit problems socially because of the wealth divide that implies, because people that own assets are clearly going to get a lot more wealthy than people that are purely wage earners. That is a political challenge, and that is a daunting political challenge. But the fact is that at the moment, kicking the can down the road pretty much means that, okay? In terms of the cycle, I think we're in the calm phase right now, but I think we're coming to the end of that calm phase. We're you can cite different markets, different asset classes, but there are a lot of signs clearly of speculative froth. There's no mistake about that. But when I say about, the calm phase, I'm talking about all markets worldwide, and we cover about 90, and the majority are in that calm phase right now. Some are starting to move more speculative, I would accept. The danger sign where you don't really want to own risk assets is turbulence. We're not there yet, but you can turn to turbulence very quickly during an accident. I mean, just look at what happened in 2008, for example.
Right. So you think we're still in calm and we have a speculation ahead. On the one hand, that is striking to me, Michael, because the S&P is already so richly valued. However, I would say that in the stock market, the assets that have gone up are mostly high quality companies that have just reached absurd valuations. They are not in highly speculative companies that may not exist in a year. I think in the stock market you're beginning to see some speculative names in trashy companies, let's so called. I mean, in crypto, it is a different story. But I agree. Yeah, we have not reached these speculative excesses of mid to late 2021.
Yeah, it can clearly go on. As I say, I mean, to come back to the saying, I mean, you enjoy the party, but dance near the door. You've got to be cognizant of what could go wrong. And if you look, there's a slide I've got, which is slide 8, which is looking at the risk exposure of world investors. That's well worth thinking about. And what this is basically showing, and this is a global picture, so this is not the US. The US is a little bit more pointed than this, but this is looking at world investors' risk exposure. Now, let's just explain how we get that. We get this from looking at flow of funds data, and what we're showing is the exposure of investors to risk assets relative to safe assets in their portfolios. Safe assets are government G10 government bonds and liquidity or cash, liquid assets. Risk assets tend to be equities. They tend to be cryptocurrencies. They also include corporate debt, and they include emerging market bonds. And what you can see here is a line, which is the orange line. It's benchmarked at 0, which is a rolling 5-year average of asset allocations to those asset classes. So that's risk neutral. If you go above that, 20 units is one standard deviation, 40 is 2 units standard deviation. And what that's basically saying is that you get a cycle. That cycle is around 9 to 10 years in terms of risk. It's very different from the liquidity cycle. The liquidity cycle, which is really a refi cycle, is about 5 to 6 years, but this is looking at risk exposure. And what you can see is, some evidence, and I'm not going to hang my hat on that, but some evidence of a repeating cycle, and we've got to be alert to that. And what also slightly troubles me is that despite all this euphoria, in terms of actual positioning in markets, you're seeing investors beginning to take money away from risk assets and put more towards safe. They're still net into risk assets relative to their benchmarks, but they're beginning to roll over. So what that's really saying is a lot of the big gains in prices are coming on a very narrow investor base. If the majority of investors are actually moving the other way, what you're seeing is these spikes in risk asset prices are probably on lowish volumes or lowish allocations. And what's more, this is not a US picture, this is a global picture. So a lot of other markets are more depressed than the US for sure. The US has clearly been a star here.
And Michael, so the 5 to 6 year liquidity cycle, was there a new liquidity cycle that was born in 2022 of the upcycle? And where does that take us? In other words, when would the peak in liquidity be? When would the peak in risk appetite and risk assets prices, Bitcoin, be? And of course, it doesn't follow everything to the T, but just to give a sense of what your 5 to 6 year model would say. Would it say that the top is in 2025, 2026, or what does it say?
Okay, well, if you go back to slide 9, that's looking at the global liquidity cycle. If you followed that religiously and said, okay, this is what you must do, you would be expecting a correction in markets by the end of 2025, and you'd be certainly paring down your risk exposure kind of a bit before that. I mean, in anticipation of that. That's looking at this thing in very straight line terms, if that's how it works. So in other words, we've got more liquidity to come in. That black line could well go up. And that's what I've been saying. I mean, I'm not denying that's the case. What I'm saying is you've got other challenges, and those two particular challenges, number one is the debt maturity wall, which is coming forward, which is something which is not featured on that chart for the simple reason that that's an increased demand for liquidity through unusual circumstances because of the echo effect of the COVID emergency of investors turning up their debt, and now that has to be repaid. The chicken is coming home to roost and all that. So that's an issue we've got to be alert to. The other two factors are, number one, are we really certain that the Federal Reserve is committed to expanding liquidity? And it may talk loosely about cutting rates, or it's trying to give an impression it's being a little bit more hawkish. But I think at the end of the day, they want to cut interest rates. But what does that mean for liquidity? That's the important metric. And I'm not certain, or so certain as I was, that they want to expand liquidity. I'm still unclear about what Scott Bessent will do in terms of funding, but we will probably address that pretty soon in the new year. And then the big uncertainty is China. And I think there are, this could fall both ways. It could easily be that China imparts a huge liquidity boost to the world economy, because it needs to. It needs to get out of its debt problems. But at the moment, China is not responding, because what's paramount in China right now is the Yuan US dollar exchange rate. They don't want to give that up. There may be a route, as I've said, around that by devaluing against gold, but who knows? I mean, that's the uncertainty. So I would say, in my view, is keep going for now. Okay, just keep an eye on these on some of these indicators because they could clearly sour quite quickly. But make no mistake, we are in the late stages of a bull market. That's absolutely clear. The bull market has been running for over 2 years now. Okay, we've been bullish through that time. Thankfully, we've been lucky in that regard. But I notice a lot of other commentators now starting to get bullish after having been bearish through most of this period. That's what makes me nervous. And I listen to some of our clients, some of the investors who have been with traditional managers, and they're saying, well, look, what have my portfolios done over the last 3 years? I've had an average return of 6%. That tells me they're not going to dive out of markets quickly for the simple reason that they want to stay at the party longer to reap some of these rewards others have been getting. And that's often a dangerous time.
So you think the party will continue, but it's getting a little bit late in the
I think it's
party?
getting late, and I think there are uncertainties there. And we were very bullish coming into 2024,
Yes.
and I'm a lot less comfortable coming into 2025. It's very difficult to say there'll be a big correction because I think there's a number of balls in the air that I just can't predict. I don't know what Scott Bessen's going to do. I don't know what the Federal Reserve really intends to do with liquidity, and I certainly have no idea what China will do. I know what China needs to do, but I've got no idea what it will do. And those are the uncertainties. But those are the factors I think to watch.
And Michael, how do you think that the dollar is going to go, especially given interest rate differentials? Basically, the European Central Bank and other central banks are cutting interest rates while the Federal Reserve is cutting a lot less, and therefore
Mhm.
the dollar is strengthening. Are you a bull on the dollar right now for that
Yeah,
reason or other reasons, or are you no?
yeah. I'm bullish on the dollar. I've been bullish on the dollar medium term. I mean, I must admit that I thought that the Treasury would try and weaken the dollar coming into the election. They didn't do that, so I was wrong in that regard. But I only thought that was anyway a sort of a temporary respite. But the trend of the dollar is clearly up, as you've seen from the charts. I think everything is now behind a stronger dollar. I'm not saying that's a good thing or a bad thing. I think that's just a fact. We've got a stronger dollar. The dollar is a wrecking ball for the world economy. And we've got to recognise that a strong dollar is not bullish for growth long term, and certainly not bullish for foreign markets long term. Just look around the world, see how many people are struggling and just look at the unfolding political events. I mean, this may be partly Donald Trump coming in, but partly as well, I think it's because of the strength of the dollar. It's putting a lot of pressure on foreign governments. So, the dollar needs to change direction. But why is it in the interest of the incoming administration to do that quickly? I just think it's a great negotiating tool for bigger deals.
And you write about how when the dollar is strong, that puts pressure on other central banks, foreign central banks, non-U.S. central banks, to tighten policy, which causes global liquidity to go down. Whereas when the dollar is weak, that causes the Federal Reserve to relax conditions, which causes global liquidity to go up. Yeah, what's your view on emerging market stocks? I mean, I know India has been on a massive bull market, and China did have a speculative boom in September and October, has kind of stalled out since then. But yeah, what do you think about Chinese equities, Indian equities, as well as other emerging market stocks?
Okay, the two things that drive emerging markets, without any question, number one, the dollar, number two, the temper of the Chinese economy. You've got a strong dollar, which is negative. You've got a weak Chinese economy, which is negative. I have no interest in emerging markets right now. It's not a great place to be. And you can see that by looking at the currency tensions that are whipping through these markets. If you look forward and you say, well, okay, the Chinese economy has got to get going, and they're going to have to monetize significantly, and the dollar needs to adjust in some form, then I'll come to the party and say, then pile into emerging markets. But I'd be really wary about going in now. I think there's no reason to go in now until you see those events. So I think on that score, that's clear. I think the thing to recognise in terms of understanding global liquidity is it's the whole adjustment process is very asymmetric. If you've got a weak dollar, okay, what happens during a period of weak dollar that we saw really through the 60s, 70s, 80s, 90s, etc.? Through that whole period, you had a background where a lot of foreign governments wanted to, wanted their currencies to remain competitive against the dollar, and so if the dollar went down, they eased. So you basically got a lot of global liquidity being generated, particularly outside of the US. And the Federal Reserve was in a position where it probably wanted to pump liquidity into the system at the same time. Maybe that was the cause of a weaker dollar, who knows? But ultimately, what you've got is that period of weak dollar was a huge expansion of liquidity. With the US dollar going up, you're in a very, very different framework. That could unwind because you've got foreign governments withdrawing liquidity unless they accept their currency weakness against the dollar. What we've been in is a situation where the Fed and the Treasury have eased, so they've taken pressure off. But clearly, if the Fed and the Treasury are easing and other governments are not, then you can absolutely understand why we've been in this period of US exceptionalism. That's not rocket science. It's simply because the only easing that's been imparted is coming out of the US. And that's why US capital markets have been so buoyant. And the question is, what could change that? What could change it is the Fed tightens, the Treasury decides that it's not going to be so generous, or the dollar suddenly whips lower because of capital outflows. But as far as I can see, none of those factors are on the horizon near term. But that doesn't mean to say we shouldn't be complacent.
And Michael, what do you think about when I say the phrase "the everything bust"? Because you recently titled a piece "The Everything Bust." What would that look like of a dramatic repricing of assets downward? You write about how we've kind of had the everything bubble going up, but what would everything bust look like?
Well, if you go back to the chart on page 12, that came from the report that we wrote called "The Everything Bust," and I did say right at the beginning of that report, spoiler alert, we don't expect it's going to happen near term. But what we've got to acknowledge is what could go wrong. Where is the fire escape? And what this is saying, again, to recap, is this is the relationship between debt and liquidity. In a refinancing world, which is the world we're in, you've got to understand that debt needs to be refinanced. The liquidity cycle is a debt refi cycle, moving 5 to 6 years, which is the average maturity of debt. And that's determines the cycle. But what that ratio is broadly telling us is that when the ratio is below the dotted line, you've got abundant liquidity relative to the debt roll. And what this tells us is that's when you start to see big asset bubbles. And what we've been in is an unusual situation where you've had a lot of liquidity relative to the debt roll because A, liquidity came in because of the COVID emergency, and B, debt was termed out because of very low interest rates. And a lot of corporations were in a situation where they could do that. Some didn't need to borrow. Those that did could exercise low interest rates at long terms. And that is coming home to roost because that orange line is going up. Now, that orange line could keep going up, and we stopped that chart in 2027. It could go into 28, 29, but that's probably too far ahead to look right now. But you can see that this data series is stationary in a statistical sense. In other words, it's mean reverting. It flatlines, but the ratio tends to equilibrate around that level of around 200, 210% or something like that. Now, we're going back, we're mean reverting. That's clearly putting more tensions into markets. Every bubble has coincided with a period where that ratio has been low. We've got a everything boom right now, everything bubble, where everything seems to be going up, certainly in America. And in that situation, you can see why, because there's been so much liquidity being created. If you start to go higher on the page and you go above the dotted line, we're going to get the reverse of that, which is called the everything bust. And that's really what the report was about. We're not there yet. We may be some years away from that, but that maybe is what's coming. Now, what will avert that is central banks keeping that ratio around the equilibrium. So they've got to start managing that. So forget all this stuff about, this is what the report was about. Forget this stuff about debt GDP. It's meaningless, okay, as far as I can see. What you need to do is look at debt to liquidity. It's all about liquidity. And, maybe I'm a golfer with one club, but at the moment, this is the club you need to get the ball in the hole.
It's been a good club over the past few years. Michael, we talked a lot about central bank liquidity. When it comes to the private sector liquidity, how much are you weighting things like initial public offerings, raising money with investment bond offerings, either in the investment grade or high yield market, leveraged loan market, collateralized loan obligations, as well as private credit, which is not a new thing, but has grown tremendously. And I know that at least when I go to the St. Louis Fed, which has these great charts online to look at bank credit, they are not including private credit. So when you look at a chart and it can appear as if the bank lending has contracted or is only growing anemically, whereas I don't believe that is the case, that the amount of lending activity in the United States has actually been quite high if you include private credit. So as a statistician and someone who's measuring and adjusting your index to make sure it's accurate, how are you accounting for the rise of private credit as well as the other capital markets activities that are more traditional, such as underwriting bonds and IPOs?
It's a very good point, and I think that you've got to say that if you go back before the GFC, people would not have included shadow banks in their assessments, and clearly, everybody does now because we can see that they're important. And the problem for financial markets is that financial markets or financial analysts always bear the impression of the thing that last sat upon them, rather like a cushion. So the last problem was shadow banks. So everyone's now worried by shadow banks. The next problem may well be private credit. And I take your point. I mean, we look at that. We include a lot of these metrics, but what you've got to think about within the system is the difference between new liquidity creation and mobilizing existing savings. And only some part of this private credit is actually genuinely new credit. A lot of it is recycled existing savings. And what we're doing is measuring the new liquidity, the new credit part of that increase. So you've also, I mean, the bit that we're not measuring, which in our terms is a savings flow, is obviously part of that equation. But as far as we can see, that bit doesn't matter so much. It's the new credit creation which is really the critical point, and that has been, in the US case, very buoyant. I mean, that's why if you look at our private sector liquidity measures in America, they're way, way more stronger than any other country. And it's because you've had, the luxurious situation of a very easy treasury, which has fed private sector coffers in terms of corporations or banks or whatever, and this private credit phenomenon as well. It's as straightforward as that. And that partly explains the buoyancy of US markets, but also cross-border flows into the dollars. We keep saying have also been buoyant, and they've been monetized or they've been used as well to leverage further. So there's been an abundance of liquidity. So why the Federal Reserve, the Federal Reserve may claim they're running a tight policy. I fail to see that, but they can't be blind to the fact that outside of the Federal Reserve, monetary conditions are really loose. That I'm sure a 6-year-old child would realize that.
Yeah, and Michael, my final question is about the Chinese financial system and the People's Bank of China in particular. Your index of Chinese liquidity had been quite high, I think, for a lot of 2023 and maybe the early part of 2024, but it had dipped a lot. And why has it dipped? And tell us about these liquidity injections that the People's Bank of China has done. Have they gone down? Because the people, optically, the People's Bank of China has lowered interest rates, lowered, several different types of interest rates, and they've put out all of these programs supposedly where state and local governments can borrow from the central bank, and where even investors can borrow money from the central bank at low interest rates to buy Chinese stocks, which, I mean, think about that equivalent in the United Kingdom or in the US. That is a pretty drastic step. So tell us, why is your PBOC, People's Bank of China, liquidity index so low?
Well, I think the answer is a number of reasons. I mean, one is that the announcements that have been made about potential fiscal solutions and a sort of whatever it takes mentality to say that, a little bit like Draghi in the Eurozone, the Chinese are saying they're now going to, try and address this problem. And fiscal policy seems to be the way to do that, with some sort of very large package. Now, they haven't really told us the size of that package. We don't know. It's probably $1 trillion, maybe $2 trillion. What's needed, I would think, is several trillion. So let's get realistic. If you go back to the US after the global financial crisis, it was at least 2 trillion. So, let's say in China's case, it's a bigger problem. Maybe they need 3 trillion. So we haven't had that announcement yet. Also, what we don't know is how it's going to be funded. Is it going to be funded from existing savings? Well, that's not going to be a solution. What they need to do is to monetize debt. So they've actually got to create liquidity of that magnitude. Now, what that would require is the banks doing the funding. Okay. In other words, the banks have to buy the bonds and they have to monetize the system. So that's how it gets into financial markets. Now, have they got the ability to do that? Yes, because the banks have been basically given more capital, a trillion yuan of capital, so they can expand their balance sheets, and that will facilitate some extra bond buying. So there's clearly intent there. The PBOC has been buying government bonds, and they've increased their government bond buying dramatically in the last few months in percentage terms, but in absolute terms, it's still that's just scratching the surface. But again, they're showing intent. Now, what I'm trying to say here is that they're showing intent, but they're not really coming up with the goods in terms of the amounts of money. We're talking, at the moment, we're still scratching the surface in terms of liquidity injections. Overriding that from a tactical point of view, so strategically they may be there. There's no question. Okay, they may be there. We don't know, but we suspect they may be, and that this may be a whopping great bailout that's coming. But if they print money along the lines that people are suggesting, make no mistake, the yuan will not go up. The yuan will devalue because this is a big money printing exercise, which is necessary, and this is what all the markets are telling us, because China is suffering debt deflation and a falling real exchange rate. So this is the issues. Classic debt deflation. In terms of what the PBOC is doing right now, which is somewhat contrary to that statement, is that they're trying to protect the yuan, the nominal yuan, against the US dollar. And they are taking liquidity out of the money markets on a tactical basis, day after day, try and make sure that the strong dollar doesn't affect them or doesn't affect the yuan too much. Now, I suspect that they're holding back on the announcements of big fiscal spending and how it's going to be funded until after Donald Trump's inauguration, until they're clear about what the Trump 2 administration will do. But as far as I can see, there is a big deal that needs to be negotiated here pretty fast. The Chinese economy is not in great shape. Everything that we look at seems to suggest it's skidding badly. The bond markets are confirming that. And I think the strong dollar is maybe a deliberate tactic, who knows, to hold China's feet to the fire. And, to come back to the Capital Wars book I wrote a few years ago, this was already the theme of it, that you've got two big economic powers here, are too big and too important and too integrated to step aside and ignore one another. They've got to come together and do a deal. And that deal has got to be, one that's obviously agreed on both sides. But America now has all the, excuse the pun here, trump cards. And it does. And China will have to negotiate in some way, to get this deal done. But China needs its economy to be righted, and that definitely needs some massive devaluation of the currency. And whether that's against gold or against the dollar, who knows? I suspect it's going to be mainly against gold.
And Michael, I haven't asked you about really economics or economic conditions really at all, because you're the liquidity expert. I like to ask people, what they actually study. But just in the U.S., the inflation has fallen a lot without there being a huge rise in unemployment. So the U.S. economy has outperformed its global peers, Europe, China, and Japan. You write in one of your reports that China's huge industrial footprint makes a large impression on the world economy. So when the People's Bank of China tightens, world GDP feels the icy blast of weaker demand. What is your economic outlook in the US and Europe? Because people in the US have been worried about a recession for so long, and so far it hasn't happened. However, if the Federal Reserve keeps interest rates where they are and only does 2 or even 1 or even 0 interest rate cuts in 2025, as inflation continues to fall, the real price of money will actually go up. And so in real terms, the cost of credit will be, and cost of money will be much more expensive as inflation continues to go down. So I know for a long time you've been fading the recession, and that has been correct to do in the US. Do you think the U.S. finally will have a recession in 2025? And also your views on the economic situation in Europe. Thank you.
Well, I think in terms of the US, I mean, if you've got a government that's running a 7% budget deficit, and you've got a Federal Reserve that's doing not QE, injecting liquidity, why should there be a recession? And, that's been the reality for the last 2 years. Economists have been derailed by putting far too much faith in the yield curve, which I've always argued, and I did academic research on this, to say it's a failed, flaky indicator. You need to look at more robust indicators. And one of the reasons that it's a failed indicator is that essentially the Treasury, through its yield, its not yield curve control mechanisms, is basically forcing yields down by funding so much at the short end and really creating a scarcity of coupon issues around the 10-year tenor. What that means is that yields have actually come down at different times by 100, 150 basis points. In fact, there's a very clear chart that I put in the pack, which you can look at, which is, I think, slide 6, which actually looks at the degree of yield suppression that's gone on in the US. And you can see that through these different mechanisms of not QE and not yield curve control, that basically this has been done. Now, that shows you, and what it's really trying to say is that 1.5 there is saying 150 basis points of yield suppression. Those are our estimates, and that's done through looking at bill issuance relative to other types of coupons and whatever. And what that is telling us is that there's been this yield suppression, but that's beginning to come down right now, and that's one of the issues that you need to think about. That yield suppression has distorted two important metrics. One is the yield curve. So if you add 150 basis points back to the yield curve, is it upward sloping or
Yes.
is it inverted? It's upward sloping.
Yeah.
Okay, great, because that's the reality. So if you didn't have this bias by Janet, bias in the yield curve, no one would have ever thought about a US recession. But a lot of economists have been fooled by this data. You put back this yield distortion, and the yield curve is telling you exactly what it should be saying. Okay, slowish growth, but no recession. Okay, what is the other effect it has? Well, it distorts the tips market.
Treasury inflation protected securities. Yep.
Correct. So if you look at break-even inflation rates with a higher notional 10-year yield, actually break-even inflation is not 2%, as Jay Powell keeps telling us. Okay, it's actually nearer 3.25%, 3.5%. And that's probably the reality, which is why you've got these monetary inflation hedges like Bitcoin and gold in such demand.
Wait, inflation break-evens are at 3%?
No, they're just over 2. But what I'm saying is if you add back this 150 basis points distortion to the long end of the nominal market, you're going to get a figure which is nearer 3.5%.
Okay, that's very interesting. That is, beyond my comprehension to fully get what you're saying, but I think I get what you're saying. So if the actual 10-year yield would be 150 basis point higher, some percentage of that would be an inflation expectation, and that would be measured in the tip show. That's very interesting. Michael,
this is why term premium in the market are so low and negative. It's because they've distorted it so much. They've created a scarcity of coupons by doing all this bill issuance. I mean, this is why Scott Bessent can call Janet, an emerging markets, Treasury finance minister equivalent. I mean, this is what she did. It's been very clever because it's facilitated. They've been trying probably to goose the economy ahead of the election. Very clever stuff. But, unfortunately, Scott Bessent will have to clear the mess up. And this is a challenge. It may not be that easy.
Michael, could you please summarize your views on liquidity and risk assets for 2025 and beyond?
Yeah, challenging year. More challenging than the last two for sure. I'm not risk off yet, but I'm certainly moving more in that direction. What would convince me is bigger or maybe less impetus in liquidity. As I say, more evidence of a momentum loss. And what I'm looking very closely at is what the Federal Reserve is doing. And what I'm also looking at is what the Treasury is doing. And what I'm looking at even more closely is what the Chinese are doing, particularly the People's Bank of China. And those are things which are really going to steer the course of the global liquidity cycle over the next 12 months and will tell us, whether ultimately markets keep going up or markets have a significant correction.
And so, Michael, you say a challenging year. I'm not going to disrespect you by asking for an S&P 500 target, but does a challenging year still mean a positive year for U.S. stocks and for Bitcoin?
I think for both of those. I think that let's take each separately. I think that in terms of the S&P, I think the S&P could. I can see a situation where the S&P could be up because the liquidity is there, and I think in many cases the U.S. equity market is really the only game in town for a lot of investors. So I think that's possible. And the economy, as far as I can see, won't be that bad unless you get a Chinese economy which really does implode. There's clearly uncertainties there, but let's say base case, I think it's possible that the US market could be higher. by year end. I'm not convinced by that. I was a lot more convinced in the beginning of 24 would be higher, but less convinced now. But I think it's possible. Okay, so I'm not forecasting a correction, but I think it will be a tricky year. In terms of Bitcoin, my view is very simply that you should be buying the dips in Bitcoin. I don't know how big those dips can be because it's a combination. A lot of it is emotion, and it could be sold down significantly. But I think that's a great long term buying opportunity because I think it's become a global asset. It's a global inflation hedge against uncertainty and monetization, and I think it's going a lot higher.
Michael, thank you so much for sharing your time. You've been speaking for a long time. You're an incredibly smart analyst, and I really like the way you talk about markets. And I know many in my audience, probably everybody, feels the same way. People can find you on Twitter at CrossborderCap, and your website is crossbordercapital.com. A lot of what we talked about, we had a chart. So if people are listening to this on Apple Podcasts, Spotify, or other podcast apps, they can get that video version by going onto the YouTube channel, which is called Monetary Matters. A reminder that episodes of Monetary Matters come out every Wednesday and Sunday. During the Christmas season, the holiday season, we might release a few early, so just to get them out there and maybe take a break, but we'll see. But people can find me on Twitter at JackFarley96. Thanks to everyone for watching, and until next time.
Thank you.
Thank you. Just close the door.